Hello, everyone. Pleasure to be here today. And I was going through the translations of the previous speeches. Those were very, very interesting as well. So today we go through the oil markets. Quite a lot of moving parts here. And that's part of the reason why we've called it an unsteady state. What do I mean by a lot of moving parts? We have demand, which has changed quite a bit since December. It's rebounded significantly in response to lower oil prices from where it was at the start of last year. Supply is changing as well. And supply is not only changing in the way people had expected it to, i.e. going down, but some places like Russia, Saudi Arabia, Iraq, supply is going up, whereas in the US, supply looks like it's falling. So again, a lot of moving parts, and that's what we'll sort of look at today in our oil market outlook. I've been told I have 18 minutes, so I will stick to that time. We'll go through 4 stages today, though. The first one would be almost like a time tunnel. Before we look at the outlook, I feel it's very, very vital for us to look at how things have changed historically, to put all of this in historical context, and then we move on to how oil policy has shifted. In particular, how Saudi Arabia has changed its oil policy, starting over there at the end of November last year, and what it actually means for the oil markets going for the next 2-3 years. We also look at how demand and supply have changed, again, historically, as well as how we expect it to change. And we sort of end with our price outlook in terms of this year, 2016, as well as a more longer-term thematic view on volatility as well as oil prices. So, without further ado, the time tunnel for oil is very interesting because oil has always been a very unique commodity. And the reason I say that is if we were to chart this graph for iron ore or copper or any other fundamental resource commodity, and just to explain this chart, the light blue is non-OPEC supply growth, right? And that's charted on the right-hand side over there. And the dark blue is oil prices. Now, any other commodity, you would have always seen a straight line sort of replicating. Whenever you had extra supply, prices would fall. Whenever you had a deficit of supply, prices would increase, etc. But oil is very, very different up until November 27th, 2014. It was different because OPEC always managed to manage the system. And when I say OPEC, mostly Saudi Arabia, whenever, for instance, in the 1998 to 2000 period where we had the massive fall in non-OPEC supply, we had Saudi Arabia boosting supply to meet the market or manage the market's price expectations. Similar thing happened in 08-09 where we saw the big fall in oil prices, and then we saw OPEC adjust production. So from a historical context, we've always had the boom and bust cycle, but it was always managed by OPEC. They produce 1/3 of global oil supplies. The 90 million barrel per day market, they produce roughly 30 million barrels per day. And that's why they had a lot of leverage in sort of turning on and turning off the taps. However, last year, something changed. It was not only supply racing ahead, but global oil demand was softening quite a lot. And just to give you a few numbers there, and that's the extent of the surplus there that you see in the dark brown bars over there. Going into the OPEC meeting and the reason we saw the price fall, etc., Saudi Arabia had 2 things that we're looking at. The most common one we all know is they were looking at how fast US supplies and North American supplies were increasing. But together with that, the other problem was global oil demand. Global oil demand was actually softening at a very, very frightening pace for a lot of these OPEC countries. And just to give you numbers again, globally, we grew at 1 million barrels per day in terms of demand since 1999, roughly, on average. In 2014, we started growing only by 500,000 barrels per day. Part of the reason is to do with China. Chinese oil demand growth in 2014 dipped into negative territory. It was the slowest rate of increase in Chinese oil demand since the 1990s. And that spooked the market. It spooked the Saudis because they were thinking, we have two problems here going into the OPEC meeting in November. Non-OPEC supply, as we can see in that chart over there, was racing ahead. The US was supplying to the markets on its own 1 million barrels per day, whereas globally we were not even growing by 1 million barrels per day. So the reason Saudi Arabia didn't cut and has changed its oil policy essentially was to do two things. Because if you looked at oil in the energy pyramid globally, it was one of the most expensive sources. And there's a lot of substitution taking place. The substitution was taking place all the way from China, where they're using natural gas-fueled buses in most of their big cities, to countries like Brazil, where taxi drivers are spending the extra money to install flex fuel vehicles that they can, run gas as well. So Saudi Arabia was essentially spooked by the fact that we are also seeing the consumer, for the first time in a very long time, becoming the new swing. And what do I mean by that? Is the consumer is increasingly able to choose what energy source it is able to consume. And that is not just a short-term trend, but in the medium-term, long-term trend as well. They are looking at things, in a sense where solar costs are falling. In some countries, solar is becoming close to parity with conventional just because of how things have fallen, and also the improvements in the battery side of things as well. All of these things sort of concocted, and that's why Saudi Arabia decided, okay, if we cut production in November, two things will happen. We will make sure that oil is always expensive, i.e. supported at $100 a barrel, and that was never a guarantee as well, because even if they did cut, the problem is, A, non-OPEC supply, because it's expensive, and we can go through a cost curve here very quickly. These are the expensive sources of oil that have been incentivized because the Saudis and OPEC decided to put oil above $90 a barrel, which was their preference rate. So if they had cut production in November, they would have incentivized all these production sources in the US and the rest of the world, what they call inefficient, unconventional suppliers, to come into the market. And on the flip side, they weren't sure whether demand would react positively or not, because they were increasingly seeing, as we discussed earlier, alternative energies taking place. So that's roughly a context in terms of why they decided not to cut and why we had a free fall in prices since then. What's happened since then? We were roughly at, again, 1 million barrels per day of a surplus in the oil market. Now, it's not huge, because in the historical census as well, in 2011, 2012 as well, we had similar oil market surpluses. So we responded by building inventories, as we see in this chart here. Global oil inventories have been building, etc. But the real difference here with the 1 million barrel per day build is the fact that the Saudis have decided not to cut. And that has given a very, very strong signal to the market, both to the suppliers and to the demand side, that we need to clear that 1 million barrels per day out of a 92 million barrel per day market, but we're not going to do it ourselves. So since December, we've had both the supply side and the demand side starting to react, and that's where we've started to see the prices have started to recover as well after the whole price discovery process. And again, we still think that a perfect equilibrium hasn't been met yet. And the reasons are as follows. The demand side. We have got a very positive shock to the demand side since the first quarter. Global demand actually surprised to the upside. It did most of the work, more so than actually non-OPEC supply. Supply did start adjusting. You saw capex across major oil companies starting to fall. Close to $160 billion of capex globally has been wiped off the table because of what has happened. But again, we're talking about the oil market right now rather than the oil market in 2-3 years' time, when these capex would have actually brought supply. So to actually balance the market, we had demand actually do a very, very sharp rebound. And just to give you numbers here again, Chinese oil demand did a complete turnaround. We don't have a chart for it yet, as much as we have for US oil demand, which bounced up higher as well. But again, as we mentioned earlier, last year, China only grew by 2.5%, 3%. This year, for the first quarter, because of the price fall, Chinese oil demand, 7.2%. So technically, 3 times the rate at which it grew last year. And what comes as a surprise to many economists is China is actually slowing down. You look at economic indicators, you look at PMI numbers, industrial output, GDP growth revisions, etc. Everything's slowing down, but the oil demand number just stands out. And China's not alone. You look at numbers from other non-OECD Asian countries, whether it be India, where we are growing by 17% year on year on gasoline. And this is relative to 4 or 5% in 2014. So what am I trying to say? I'm trying to say that the recovery in oil prices that we've seen is partly because of a demand response. Lower oil prices have actually helped the consumer in many more ways than previously expected, and it's being seen on the gasoline side more so than the industrial side. And this is a very important point here, because typically when we look at global oil demand growth, it's both the industrial side and the consumer side that grows, whereas here you're seeing the industrial usage of oil slow down, the consumer side of things pick up, which is very unique because this is where gasoline is strong but diesel is weak, and this is a global phenomenon. So where do we go from here? We are still skeptical about the oil price rally. We think Brent will average roughly around $60 a barrel this year, $68 a barrel next year, WTI $54 and $64 a barrel. Why do we say that? A couple of reasons. One, again, on the demand side, we've seen this price response, but it's important to understand that the moment prices go above $70, $75 a barrel, these same consumers will refrain from buying or consuming as much as they did before. Because if you look at underlying economic trends, and that's what matters, from China to Russia, all of these countries are not growing phenomenally in terms of economic growth. And we really need that organic growth driver to push oil demand on a high sustainable level. So that's one point. That's one reason why we don't think the current rally in oil prices is sustainable, because the higher the price goes and the swifter it goes, the end consumer gets a very, very nasty shock. The second thing again, and this is related to oil consumers again, a lot of these non-OECD Asian countries took the opportunity to remove subsidies when oil prices fell. India is a great example. China also not only removed subsidies, they actually put gasoline taxes. They raised it 3 times since November because of the oil price fall. Similar story across other big countries, Indonesia, Thailand, etc. What does it mean for the oil market? Typically, the end consumer had that cushion. Whenever oil prices rebounded, they always had the subsidy cushion from the government. This time, that's not there, and the economic climate is not conducive as well. So risks on the demand side actually relapsing if we see prices rally above $70 a barrel. Now, the other thing is on supply as well. If you look at these cost basins, this is the entire US undrilled resources and how their cost curve looked as of December. You see that most of them are fairly high in terms of where they are on the cost curve, but a few important things have happened since November. A lot of the cost curve compression has taken place. You see many of the independent oil producers in the US come up with statements that they've reduced their cost base by 17%, 18%, in some cases even 25 to 30%. A lot of efficiencies in the true American spirit of entrepreneurialism have actually factored in and been baked into the oil price cost curve, and that's started to compress as well. That's one other reason to be skeptical about the price rally, because the moment oil goes above $70 a barrel, you have a lot of US oil producers that will come back into the market, they will hedge their production, and they will continue producing. And this is where we say it's almost like a seesaw effect. The higher the price goes today and the swifter it goes, the lower it will be next year, because this is a lot of incremental production that will come back into the market. Fourth point here again, there's this thing called ducks in the oil markets that we're increasingly starting to use, developed and uncompleted wells. These are wells that a lot of these oil producers have said, we'll wait on it because we've spent a lot of money on it, but we won't bring them online until oil is about $70 a barrel. So that supply is also going to come into the market once we see prices above $70 a barrel. So what does that mean? And sort of concluding here with oil policy and medium-term outlook, it means that the market has changed in the way we have been used to. We've been used to a market where Saudis were the only ones that regulated supply, whereas now we have this new source of non-OPEC supply as well, which goes up and down relative to the prices. And finally, how does Saudi Arabia react to this? Because they know that, preferably for them as well, $90 a barrel is an ideal price. But if they can't get there because the shale production and the other offshore production resources start coming back at a higher price, what do? And this is where we are of the view that the new Saudi oil policy has much more different legs to what we were used to before. Saudi Arabia is now becoming a strong refined products exporter. That changes the game for them. They're no longer, used to exporting crude and importing refined products. It gives them a lot more markets to play with, a lot more efficient way of getting market share. And the second final point I'd say would be oil market volatility. Because if you think about it, from their perspective, as much as they say that the consumer will be affected by higher oil volatility, from their perspective, volatility is good because they have the lowest cost base. And for them, a volatile price environment means that other producers, expensive producers, will think twice before investing in a resource. Because if you think about an oil producer in the US, every single investment decision that they make is almost like a call option. And the price of that call option increases the moment the underlying volatility in prices is high. So the Saudis know that, to average a high price, volatility is important. And that's part of the reason why we do think that this whole new era for oil, as much as the geopolitical side we haven't gotten into today because of time restrictions, there is still a lot of scope for volatility. I'd end here by saying that we're still not out of the woods for oil. A lot of balancing still to be done, but there are positives as well in the long run. There are decline rates in offshore and onshore fields globally in conventional sources that will help support the oil price. And new sources of oil are always welcome. The Saudis are not particularly against US shale. They're only against the pace with which it has been coming. They think it's been too fast to come into the market rather than totally saying that US shale is not required. They have repeatedly said, the Saudi oil ministers repeatedly said that it adds depth to the market. So we do need US shale, and this is my final slide as well. How do we see things going by post-2016? We do need to see 5 billion barrels of oil that is currently in stocks to be drawn down, and that's a huge number that needs to be done next year to balance the oil market. And also, we need a sustainable price, roughly around $60, $70 a barrel, to actually incentivize some US oil production, because if you look at fields in Qatar, Kuwait, etc., they're all declining, and we really do require that incremental production. As of now, the Saudis are pumping record amounts of crude in the market to meet the extra demand, but it is not sustainable in the long run, and that's where our price forecast of $68 a barrel next year actually comes through. It is an ideal price where we see a little bit of US production, not too much, and we also see a price which is favorable for demand as well. Long run, I think we are of the view that there are significant possibilities for demand to be the new swing. What do I mean by that? There's battery technology that's improving, solar costs are falling as well. Combine all of those, and in the future, you'll have demand that's swinging as much as supply as well. So roughly, I would say a sustainable basis, $100 per barrel plus oil is unlikely, at least for now, until we see massive outages. So with that, I turn the mic to our moderator.